You ever have one of those moments when you're like, OMG, that's the way you're supposed to do it? Oh, wait, that's what that's for? Like peeling a banana more efficiently, or the lines on a Solo cup.
Yeah, I remember when I first heard about the Solo cup lines, but anyway.
It's crazy.
Well, that's exactly how we felt when we first learned about the power of dividend investing for passive income after years of investing. And we want to share that with you today, so stay tuned.
What's up? I'm Nadia.
And I'm Nicole,
bringing you another installment of the Wealth Twin Show,
where we teach you how to invest, save, and manage your money on the road to financial independence.
And what does that mean, Nicole?
It means we're going to teach you how to fire your boss.
Yep. So if you're new here, make sure you hit the subscribe button. We're making these videos weekly.
Yep.
Our mission is to help you take control of your money so you don't want to miss anything.
Yep. Make sure you hit that notification bell too so you don't miss the videos.
Yep. So let's get it.
Let's get it. Now, when it comes to investing for passive income, right? Because originally it's our goal to be financially independent. And especially if you want to be financially independent and retire early, then you need to create different streams of passive income.
Yep.
If you want to invest in the stock market and create a stream of passive income, then you need to focus on dividend investing. That's because the only way to achieve passive income through investing in the stock market is through dividend investing. Let me be clear and let me say that slow.
Yep.
Dividend investing is the only way to get passive income in the stock market.
Yep. If you're focused on financial independence and passive income, you need to be a dividend investor.
Say it again.
If you're only focused on prices going up and down, then you're trading. All right? If you want to be successful, you need to understand what your investment strategy is and why. It's like investing in real estate. Either you're in it to start flipping houses to make a profit, or you choose to be a landlord and you want the cash flow. Investing is not black and white. It is not dividends versus speculating. It's about why you are investing.
Mm-hmm.
If your reason is passive income, then dividends is the only game in town.
Mm-hmm.
Now, how do you get passive income through dividend investing? It's through dividends. Let's give some examples that will make it easier to understand what exactly a dividend is, okay? Yeah. So you invest in real estate as a landlord. Your passive income would be the rent. When you loan someone money, your passive income would be the interest on that money. The same concept applies to dividend investing. The passive income you expect from a stock is a dividend, right? All of these are cash flows you make just by holding that investment. In other words, these cash flows are your passive income.
Mm-hmm, mm-hmm. Now, after you know all this and we're talking about passive income and how do you achieve it, what makes dividend investing such a powerful investing strategy to create passive income?
Yeah.
Well, for us, we think there's really 4 reasons that we want to discuss today. The first reason is the compound effect that you get with dividend investing. With dividend investing, you actually have 2 sources of compounding taking place. The first source of compounding comes from reinvesting your dividend payments to buy more shares.
Yep.
For example, you own 100 shares of stocks XYZ, right? XYZ pays you a quarterly dividend, but instead of cashing out that dividend, you decide to reinvest it to buy more shares of XYZ.
Yep.
Now you have 102 shares of XYZ. After that, you receive a dividend payment based on 102 shares. As you keep reinvesting to buy more shares, your dividend payment also increases. It's a nice little cycle. Now, the second source of compounding comes from the growth of dividends. When the economy grows, dividends tend to grow with it. That's because companies that provide dividends are growing and earning more through their business activities. As the price of stock increases, so does the dividend payout.
Yeah.
Earnings are the driver. Now, to illustrate this, let's take a look at a quarterly dividend of SPY for the last 20 years. SPY is an ETF that mimics the S&P 500. Now, if you don't know what the S&P 500 is and why it's important, please check out our other video about stock market basics. Okay? Now, let's get back to our example. As you can see by this graph, over the last 20 years, as the price of SPY rose, so did its dividend payout.
All right. So, number 2, dividends are also like a social contract. Think about it. A company only starts to give a dividend when they believe they will be profitable enough in the future to be able to give a part of their profits to shareholders in the form of dividends. Mm-hmm. The dividend is usually a very conservative number, so that even if the profits fluctuate, they can still pay the dividend for a long time in the future. Right? Investors are willing to buy dividend stocks because they are reasonably certain that they will receive the dividend. Nobody wants to buy something they're not reasonably sure of not doing, right? Mm-hmm. Companies shy away from cutting these dividends for that reason, right? It will send a bad signal to the market, and that company will be penalized by their stock dropping if they choose to not, and they cut their dividends, right? If I buy stock in your company for the sake of the dividend and you cut my dividend, no gracias, I'm out of there.
Deuces.
Yeah, only unless there's a justification for it and it's temporary. Other than that, I'm out. I'm selling my stock. I don't want it anymore.
Now, if you agree that dividend investing is a powerful way to get passive income, I want you to type dividend investing power in the comments.
Dividend investing power.
Yep, and let's continue to get this popping, okay? Now, number 3. Half of the returns, and this is shocking, half of the returns from companies that are listed in the S&P 500 index has come from dividends. For example, over the last 10 years, from 2010 to 2020, Coca-Cola has had a return of over 250%. Yeah. About 56% of that has actually come from the price of the stock increasing. The other 200% has actually come from the reinvestments of dividends, which is crazy.
Yeah. Number 4, dividend investing puts you in the position of a business owner, right? As the author investor Loa Miller stated, the very attention we place on the rising dividends puts us squarely in the position of an owner of the company, of true investors who understand that a satisfying and reasonable return from a stock investment isn't a gift.
It's
not a gift, okay? As a dividend investor, you are a partial owner of a company. You should only be concerned with the dividend. We are not in this for cool points. We are in this to make passive income.
That's right. So now that you know this too, how do you get started in dividend investing? That should be the logical next question, right? Well, there are 3 investing strategies that we want to discuss that you can use to go into dividend investing for passive income. Number 1 will be high dividend yield investing. This is when you invest in companies that have a high dividend yield. Now, there could be a few reasons why this dividend yield is high. Yeah. One reason is because the company's stock price is being penalized for something outside of their control, right? An example of this right now I would consider would be Royal Caribbean, the cruise line. Right now, its stock is being penalized in part due to the pandemic, right? And the current dividend yield is very high. It's a little bit over 7%. Yeah, and the stock price has dropped down to around $40 a share. A high dividend yield investor might see the situation going on with Royal Caribbean and decide to buy the stock because he's getting a dividend stock at a very low price. She also has to believe that Royal Caribbean will not go bankrupt and will be able to pay a dividend for a very long time in the future. She's actually taking a bet against the downside being bankruptcy. Yeah. Once she decides to get into the stock, she is no longer concerned with price fluctuations. All this investor cares about is betting on that this company will not go bankrupt and that this company will continue to pay dividends. Now, if she's right and the company doesn't go bankrupt, once this pandemic is over, the stock price should go up too.
And cruises should start again.
Nadia loves cruising. Anyway, now she gets the benefit of both having a price, getting into a dividend stock at a very low price, and she also gets the benefit of having a dividend, right? Now, once the stock price increases, she can then decide to sell the stock and buy another stock that she believes is being penalized that has a high dividend yield. You can just continue this process over and over again. You buy low, you sell high based on the dividend yield, okay? It is a bet that you're taking. Now, if you make this bet and you're wrong, you're going to lose money. But if you make the bet and you're right, you continue to do it. Now, another reason why a high dividend yield investor might be interested in high dividend yield is because they're looking for companies that have matured, they're not growing, but they have a ton of income.
Yeah.
These companies can only get a high price for their stock because of the dividend, right? There's no other reason. If a company is not
Making
growing
money.
and is not giving you a high dividend, there's no reason to buy the stock, right? If this company is able to pay a high dividend and has a ton of income to do it for a long time in the future, regardless if it grows, you buy that stock. That's what a high dividend yield investor does.
Yeah, that's what you care about. Right? So number 2, dividend growth strategy. This is when you're trying to find companies that are mature enough to pay a dividend but are still growing, right? You're buying very profitable companies with a small dividend. You are making a bet that the company will continue to grow and they will eventually increase their dividend. On top of that, you're betting that their share price increases too. So if you get in early enough, you can enjoy a growing dividend that is based on their earnings as well as the stock price appreciation. Basically, you're taking a bet on the upside, okay? An example of this would be Apple, right? However, if the company growth stops and slows down tremendously, then you made the wrong bet because it no longer fits your criteria as a dividend growth strategy, right? So let's give an example. Say you buy a growth stock at $100 because you believe that this company is doing something unique and will be a leader later on in their field, and they'll be around for a while, even though they're only paying a small dividend of like 10 cents. You believe this company has a great business model and therefore their earnings will grow and they may eventually dominate that market that they're in. Now, after a few years, that $100 company turns into a company whose stock price is now $400, right? These are why the people who bought Apple early are very happy because that's what Apple did.
And this is why dividend growth investing is actually a very popular thing right now, I would say.
Yeah.
But really, you're taking a bet. So both of those two that we talked about, high dividend yield investing and dividend growth investing, involve speculation because you're making a bet on an actual company.
Yeah.
Now, the third strategy we want to discuss is called broad-based index investing, which can be considered a middle-of-the-road approach, okay? You're looking for companies that provide dividend. You want dividends, but you admit to yourself that you don't know enough about the actual companies to make a bet one way or the other. So there you focus, your outlook is mainly a general outlook of companies.
Yeah.
For example, you buy an index fund that mimics the S&P 500, that you believe that the U.S. economy, and you believe that the U.S. economy will continue to grow, okay? Buying securities that mimic the index, the S&P 500 index, will give you a piece of some growth companies. It'll give you a piece of some mature companies. And it'll even give you a piece of growing companies that don't even offer a dividend.
Yeah.
Okay, so you get a little bit of everything and it mix and matches, right? However, when you do this, you give up upside potential of what you can get on dividend and price appreciation, but you also don't suffer a higher than average loss if your bet goes wrong.
Yeah.
Okay.
So you're kind of hedging yourself.
You're hedging yourself. You I wouldn't call it cautious, but it's more humble. Okay. Now, for example, of broad-based index investing, let's look at the ETF again, SPY. SPY is an ETF that mimics the S&P 500, which gives you, with the S&P 500, gives you some idea of the U.S. economy. It includes the 500 of the largest companies in the U.S., okay? As long as you believe that the U.S. economy will grow in the long run, you will buy an ETF such as SPY or something like it because of the dividends, right? You believe that the economy is going to grow, these companies overall in the index will grow, and therefore earnings will grow, and then as a result, dividends will grow.
Yeah. In the end, each one of these dividend investing strategies has their own pros and cons, right? But they all share the same goal of investing for passive income. The mindset of a dividend investor allows them to withstand the downtimes in the market and not sell. It's not based on emotions here, okay? It also allows them to not get too excited when the market starts to go up. You're focused. You're using dividends as the marker to determine what to buy and what to sell. And it helps limit these irrational decisions.
Yeah, emotional trading. I'm going to call it irrational, but it limits emotional trading, right? At the end of the day, you have an investment strategy. You know why you're doing it, and you know what you want out of it, which is what we want to do when we invest, okay? Now, although there are many ways to invest, if your goal is to achieve financial independence, then you need to include dividend investing. Remember, the goal is to generate enough passive income to cover all of our expenses. The fastest way to do that is to focus on activities that will bring in streams of consistent passive income. And that's exactly what dividend investing tends to do, or that's what it does. Right. Period.
Yeah. So if you like what you learned in this video and you want more videos about dividend investing or ways to generate passive income for financial independence, make sure you share this video and comment below.
Yep. We want comments. We want to know what you think about this video. We want likes. We want to know, okay? Because we want to tell you more about this. Now, as always, remember, your manners will take you further than your money too.
See you in the next video.
See you in the next video, guys.